Hello everyone, a very warm welcome to all of you. We are going to discuss about the Bollinger Bands in this video. The Bollinger Band was discovered or introduced by John Bollinger. So this is an indicator which helps us to understand the volatility. Now, what is Bollinger Band? First, there is a 20 period moving average or any period moving average you want to take. Then we take two standard deviation away points. So the two standard deviation away points on the upside from the upper Bollinger Band and the two standard deviation away points in the downside from a lower Bollinger Band. Now, instead of two, people can draw this Bollinger Band on case of one standard deviation away or three standard deviation away according to their will. But the standard is that people use the 20 period moving average, simple moving average and two standard deviation away up and down for the Bollinger Band. Now let us look at the chart and see how Bollinger Band looks in the chart. So here we are looking at the daily chart of Nifty in the investing.com charting platform. Now let us add the Bollinger Band here into the chart. See this standard 22, that is 20 period moving average and 2 sigma away upper and lower Bollinger Band has been drawn and the 20 period moving average has been drawn in red. Let us customize the way it looks a little bit. So here is our Bollinger Band. Now you may be wondering that how one can trade a Bollinger Band. The most important use is that when we have a trending market, quite often Bollinger Band take support or resistance in the mid Bollinger line and bounces to the upper Bollinger line. See here in the Nifty daily chart, what happened? That there was a very steady uptrend. Now, for quite a bit of time, what happened is that the market was taking support near or just below the Bollinger Band and was giving very good credible bounce. Now, let us look at the period when Nifty was in the downtrend. See, here also we could see that the mid Bollinger line acted as a resistance and eventually after that the price went down. Now one important point to understand regarding a move in a Bollinger Band is that if we find that there has been a sharp up move and then this lower Bollinger Band actually turns away and then the upper Bollinger Band also start tilting, then that is the point where market actually stops and there is a small price correction after that. See, this happened in this case and this happened in this case also. After the price actually turned, lower Bollinger turned from this side and the upper Bollinger turned from this side after a little fall, then we saw the goodish bit of correction. Even here it happened like this. This was a great up move. First the lower one turned and then the upper one turned and see after that there was a goodish bit of correction. The price moved lower. Similarly, we can see in the uptrend we were first looking for a turn in the lower one. In the downtrend we first look at the turn of the upper one. First the upper one turned and then the lower one flattened or turned and then we could see that there was a goodish bit of up move. So these are counter up moves, counter down moves that can be spotted in the market if we look at the Bollinger Band. Bollinger Bands are also very important when we are talking about the M tops or the W bottoms. So we have looked at the double bottom and double top patterns in the classical chart patterns. Now let us look at the examples here and understand how we use them in the Bollinger Band. Here we are looking at SBI daily chart. Now look at this position. First there was a very fierce up move and then the price moved beyond the Bollinger Band, the 2 sigma line. Then the price retraced back and then there was again up move, but this time price failed to move beyond the Bollinger Band. Now this is classically called a M top. See here the first top was little bit higher than the second top, but suppose this was not the case. This second top, even if it was higher than the first top but within the Bollinger Band, even then the pattern become valid. So ideally the first top should be outside the Bollinger Band, and the second top, if it is lower than the first top, then it is very good, but even if it is higher than the first top but it is lower than the upper Bollinger Band, classified as M top. And see, when the neckline of this M top was broken, how sharply the price fell. So this is an important way the M top is traded with the help of a Bollinger Band. Now look at the W bottom. Before that there was a very fierce down move, and now see the first bottom was made outside the Bollinger Band, the lower Bollinger Band. Then there was a pullback, and at the pullback someone sold the stock, and then the second bottom was formed, but this time well within the lower Bollinger Band. So even though the second low was lower than the first low, but as it was within the Bollinger Band and the first one was outside the Bollinger Band, this was a valid W bottom pattern. And see what happened. Eventually when it was broken on the upside and then price moved little bit higher, and then it again came back in the neckline, and then price moved higher. So in case of both the patterns, which are almost mirror image to each other, in the case of break of the neckline, someone can take trade with the stop loss here in this case should be above the top, and here in case is below the bottom. So this is one way of trading the Bollinger Band.